All right, then let's explore this in a bit more detail. Joining us now, Shem Joshua, policy analyst and advocacy officer at Sovereign Management in AFRODAD. Shem, thank you very much for your time this evening. What do you make of this announcement on the creation of two new financing windows worth about $49 billion each by the China Development Bank and the Exim Bank of China?
Okay, thank you for having me. And I have to admit that it has been a very good time looking on to what has happened or what's happening during the China Belt and Road Initiative. But first, I have to admit that we have to look at the three in its bigger picture, because this is the 20th anniversary. And it has been applauded by the Chinese government for its positive impact in providing funding to the poor countries, yes. And one way or the other, I have to admit that currently, as we speak, 22 countries in Africa are either in debt distress or at high risk of debt distress. And this means that Africa governments are struggling to pay the debt that they incurred on behalf of the states. And now looking onto the new two financing windows worth 48, actually, if you convert it back to a full figure, it's like 49 billion each. You'll realize that this is a debt, and we are trying to look at a continent that is trapped in debt and trying to repay its debt, which is taking almost 80% of its revenue. Out of $10 collected in Africa, $8 go to debt repayment. And we are looking on to what happened recently, given the speech given by the Chinese government on the increased financing using these two windows under the China Development Bank and the Exim Bank of China. But the question that we have to ask ourselves is to what extent are these financing going to be merited on the Africa development goal, while at the same time not going to increase the debt trap for the Africa.
So in short, if countries do want to tap into these facilities, they should essentially be trying to negotiate for credit on concessional terms at the very least.
That is exactly what we are trying to say, that there's need for concessionary loans that are giving these countries space, so that at all costs that they get extra financing, but they still have a room, a financial breathing space, so that they can repay their loan while at the same time servicing their development agenda goals. And that is exactly what we are trying to say. And maybe just to finalize on the same, I believe that the financing itself is not bad as per se, but the question is to what extent will it be mainstreamed down to these developing countries in terms of transparency, in terms of accountability, in terms of the legislative involvement to understand how the loans are going to be used. Because it's not just about saying that we have a new loan from Chinese government, but the question that mainstream down is to what extent will this loan be repaid, and to what extent is China going to allow these countries to have a free space or a free financial breathing space, so that they can have a good conditionality in repaying the loans. Yes.
All right. So we've also seen, especially from 2017 onward, we've seen credit flow from China falling quite a bit, right? It's essentially come off the peaks that we saw back then. Should policymakers here in Africa be actually working on the opposite scenario to what you've just suggested, that there's going to be a lot less credit coming into the economies in sub-Saharan Africa from China and any other sources? That's the new norm, and we need to adjust to this low debt scenario.
Yeah, I agree. China lenders actually account for approximately 10 to 15% of Africa private and public external debt. And it increased fivefold from the year 2000 to recent 2022. And with the reduction in China credit financing to Africa, this comes with some reasons. We know that China is a member of G20, and currently there is what we call the G20 Common Framework. A lot of issues are happening depending on how the Common Framework is going to work for these countries which are in debt crisis. And when you look clearly, you'll find that China is a bit skeptical on how the World Bank IMF is involved in debt restructuring, because China is trying to bring out the issue of debt sustainability analysis, which the World Bank and IMF is using, that this is not the best way to look onto it. And, it has led to reduction in China capability and China willingness to increase its debt. However, from where I sit, I want to say that Africa cannot grow on debt. That one we have to agree, and we have to agree at all costs. We are not going to grow our economy on debt. We need to increase our domestic resource mobilization so that when we partner with our allies like China, we will know very well that the partnership is for the benefit of both countries, whereby no one country is benefiting while the other remain on a debt distress. We are not in a situation where we need to increase debt after debt while the services, including education sector, services including health sector, services
Right.
including social security sectors are not being funded, because we have to use a lot of our cash to repay the debt. So I believe that the reduction in China credit financing it needs to open our eyes.